6 pre-formation decisions sit in front of you before any paperwork gets filed, and almost every coach I've talked to has made some of them already without noticing they were decisions. The first one is the load-bearing one. Are you in business at all, in the sense the IRS uses that word? The answer drives whether your laptop, your CRM, your coach training tuition, and your home office square footage are deductible, or whether they're personal expenses with a Schedule C label on them. That answer doesn't wait for you to file a form. The IRS already has a view formed from your activity, and the only question is whether your view of yourself matches theirs. Most coaches I see making these 6 wrong are making them by default. They never ask the question, so they never noticed there was an option. The point of working the module is to convert each one from a default into an answered question. And the first answered question, the in-business question, is the gate that opens the next 5. If you're not in business per the test, then partnership, name, entity state, and the rest stop mattering. So I'm going to walk the 4 categories first, then the IRS test that decides which one you're in, then the documentation that moves the score if you're sitting on the line. 4 categories, and the gap between them is the entire ball game. Hobby is the painful category because hobby income is still taxable, but hobby deductions are capped at hobby income. And even those limited deductions were eliminated for individuals under the Tax Cuts and Jobs Act. So hobby coaches owe income tax on revenue with effectively no expenses to subtract. Side gig and freelance are the same animal at the tax layer. Schedule C, sole proprietor, deductions apply, self-employment tax applies. The 2 words differ in how you talk about yourself socially, not in how the IRS files you. Business is Schedule C or an entity return, plus a formalization layer on top. Entity, separate books, written policies, audit defense posture. The 3 of 5 rule is the cheapest defense the tax code gives you. Show profit in 3 of the last 5 consecutive tax years, and you carry a presumption of business intent. The IRS still gets to challenge it, but the burden shifts. Without that profit pattern, you have nothing automatic to rely on, and the 9-factor test becomes the entire defense. Most coaches in year 1 or year 2 have not yet hit the presumption, which is why this video spends time on the 9 factors. The presumption is the destination. The factors are how you defend yourself in the years before you get there. 9 factors from IRS Publication 535, and the scoring is a mosaic, not a checklist. No single factor decides it. An auditor looks at the pattern across all 9 and asks whether the picture, taken together, looks like a business pursuing profit or a personal interest with revenue attached. The first 3 are operational: how you conduct the activity, what expertise you bring, how much time you put in. The middle 3 are economic history: asset appreciation, prior success, your income and loss pattern. The last 3 are circumstance: occasional profitability, your overall financial position, and how much personal pleasure the work involves. I'll walk them in groups with the coaching example on each. Factors 1 through 3 are the operational picture, and these are the ones most coaches can move inside a single quarter. Manner of conducting activity: separate business bank account, invoices going out under a business identity, bookkeeping software open at the end of every month. If your client payments hit your personal checking through Venmo, you're reading as hobbyist on factor 1, regardless of what you call yourself in your bio. Expertise: the ICF credential is direct evidence here, as is your coach training, continuing education, supervision hours, and any business consultants you've engaged. Time and effort, a dedicated calendar block for client work, regular consistent hours, and the documentation to prove the hours exist. Factors 4 through 6 are the economic history. Appreciating assets almost never applies to coaching. You're selling time, not building a portfolio of things that go up in value, so this factor is usually neutral. Past business success works in your favor if you've run any business before, even unrelated to coaching, because it proves you understand what running a business looks like. The income and loss history is the one to watch. Startup losses in years 1 and 2 are completely defensible. Every business has them. But year 5, with no profitability and no documented reason, starts looking like a hobby that costs you money rather than a business in development. That's the factor that gets sharper with time, not softer. Factors 7 through 9 are the circumstantial picture, and the financial status factor is the one that quietly trips wealthy coaches. Occasional profitability, even one profitable year inside the 5-year window, is evidence of intent, so the rule isn't all or nothing. Financial status of the taxpayer is the audit profile to watch. A high-income spouse with W-2 wages, plus a coaching practice that runs losses against that other income year after year, is the classic profile auditor's flag. Personal pleasure is the trickiest because coaching is satisfying work, and that satisfaction reads as enjoyment on factor 9. You counter it with the systematic side: written fee schedule, documented acquisition activity, organized client pipeline. Priya and Marcus are both coaching and both call themselves coaches, and the IRS would file them on opposite sides of the line. Priya has a separate business checking account, sends invoices through Dubsado, holds an ICF credential, completed 3 continuing education courses last year, and blocks her calendar for client work. Marcus collects payments through personal Venmo, holds a certificate from a weekend program, and books 2 clients a year between other commitments. Same word, coach. And the documentation gap means Priya defends business status comfortably, while Marcus would land in hobby territory under the 9 factors. Intent didn't separate them. Records did. What this test does not decide is worth naming, because I see coaches conflate it with the next layer: whether to form an entity, when to apply for the EIN, whether to elect S-corp tax treatment. None of those are settled by the hobby versus business question. Those are Module 4 questions, and they only matter after you've established that you're in business at all. Unit 2.1 has one job: pass through the in-business gate or land in hobby territory or in the gray zone with a list of weak factors to fix. The entity decision comes downstream. Pre-running it before answering this one is a common founded mistake. The action this unit asks of you is small and specific. Open the hobby versus business self-assessment, score yourself honestly on all 9 factors against the coaching examples, and save the scored sheet. If you land clearly in business territory, you move to Unit 2.2 and pick up the solo versus partnership decision. If you land in the gray zone, the factors you scored weak on are your year-end fix list: separate banking, regular hours documented, fee schedule in writing, whichever factors moved you down. Treat the gray zone as a punch list to work through, not as a failing grade. The next 90 days are usually enough to clear it before the tax year closes.